We are currently witnessing a liquidity event in the XRP markets that signals a fundamental shift in institutional sentiment unlike anything we have seen in the last 5 years. If you are currently holding a position in XRP or any major legacy altcoin, you are standing on incredibly shaky ground while the smart money is aggressively exiting the building. The reality is that the price action we have observed over the last 72 hours is not a standard market correction or a healthy pullback, but rather a structural failure of support levels that have held since 2024. Most retail investors are looking at this sharp decline as a buying opportunity, assuming that a bounce is inevitable. But the on-chain data suggests that this is the beginning of a prolonged capitulation event. In the next few minutes, I am going to walk you through the exact wallet movements and exchange flow data that prove why this February 2026 crash is the most dangerous moment for XRP holders in history. I will show you why the liquidity is drying up, where the capital is actually flowing, and how you can protect your portfolio from the cascade that is about to follow. Let us get into the weeds. We need to start by looking at the raw volume data coming out of the major derivatives exchanges over the past week. What we are seeing is a massive decoupling between the spot price of XRP and the open interest in the futures market. Usually when we see a price drop of this magnitude, we expect to see open interest wiped out as over-leveraged long positions get liquidated. However, the open interest is actually increasing while the price is plummeting, which indicates that sophisticated short sellers are piling in to drive the price down further. This is a classic predatory behavior by market makers who smell blood in the water and know that there is very little buy-side liquidity to stop the fall. The 30-day moving average for exchange inflows has hit a 3-year high, meaning that long-term holders are moving their assets onto exchanges to sell. This is not the behavior of a market that is consolidating. This is the behavior of a market that is distributing assets to exit liquidity. Specifically, we have tracked over 400 million XRP tokens moving from cold storage wallets that have been dormant since 2021 directly to over-the-counter desks. When you see whales of that vintage waking up to sell, it is usually because they know something that the average retail trader does not. Here is why this matters. In previous cycles, XRP often acted as a signal for altcoin seasons, where a pump in this asset would lead to a broader rally across the board. Today, in February 2026, the correlation has completely inverted. XRP is crashing while Bitcoin dominance is steadily climbing, which tells us that capital is not leaving the crypto ecosystem entirely, but it is fleeing to safety. The narrative that drove this asset for years was based on banking utility and cross-border settlements. But the market is finally realizing that the adoption curve has flattened. We are seeing a repricing event where the speculative premium is being stripped away, leaving only the bare value of the network, which is significantly lower than current prices. If this level of data-driven analysis is helping you see through the fog of war, consider subscribing to the channel to ensure you are always on the right side of the trade. Let us dig deeper into the specific support levels that have been violated this month. Technically speaking, the 50-week moving average was the line in the sand that bulls needed to defend to keep the macro uptrend alive. That level was shattered 3 days ago with high volume, confirming that the trend has officially reversed to the downside. When a major asset like this loses a multi-year trend line, it triggers algorithmic selling programs that operate purely on mathematical invalidation points. These bots do not care about the news, and they do not care about the community sentiment. They simply execute sell orders until the price finds a floor. We are also seeing a significant thinning of the order books on the bid side across Coinbase and Binance. Market depth is currently at its lowest point since the bear market lows of 2022. This means that it takes very little selling pressure to push the price down another 5 or 10%. The reality is that without new institutional capital stepping in to absorb the supply shock, the path of least resistance remains strictly to the downside. I want to compare this current crash to the capitulation event we saw in late 2020. Back then, the catalyst was regulatory uncertainty, and the market reacted with fear and panic selling. However, the difference between now and then is that the current crash is happening during a period of relative regulatory clarity. This is much more concerning because it implies that the selling is driven by a lack of demand rather than external fear. When an asset sells off despite a neutral news cycle, it indicates that the market has fundamentally lost interest in the value proposition. Investors are waking up to the fact that the legacy coins from the 2017 era are being outpaced by newer protocols. And more importantly, by the monetary superiority of Bitcoin. We must also address the broader macroeconomic environment we find ourselves in right now in early 2026. Global liquidity conditions are tightening as central banks attempt to normalize their balance sheets after the inflationary pressures of the last few years. In a high liquidity environment, speculative assets can thrive regardless of their fundamentals because money is cheap and risk appetite is high. But in a liquidity-constrained environment like we have today, capital becomes discerning and retreats to the hardest assets available. This is why we are seeing Bitcoin hold its ground, while assets like XRP are suffering double-digit drawdowns. The market is effectively pruning the dead wood to consolidate value into the winners. You have to understand that holding a declining asset in this environment is not just a loss of dollar value. It is a massive opportunity cost. Every day that your capital is tied up in a coin that is bleeding against Bitcoin is a day that you are missing out on the compounding effects of the primary trend. If you appreciate this no-nonsense approach to capital preservation and market strategy, make sure you join our community by hitting that notification bell so you never miss an urgent update. Now, I want to talk about the psychological trap that many investors are falling into right now. There's a concept in behavioral finance called the sunk cost fallacy, where investors continue to hold a losing position because they have already invested so much time and money into it. We are seeing this play out in real time on social media, where the community is doubling down on their conviction despite the price action proving them wrong. They are calling for a rebound based on past performance, ignoring the fact that the market structure has fundamentally changed. The volume profile for February shows that every minor rally is being sold into aggressively. This is known as a bull trap, where the price ticks up slightly to lure in retail buyers, only to be slammed down by heavy sell orders from larger players. We have identified several large sell walls sitting just above the current price action, acting as a ceiling that prevents any meaningful recovery. Until those sell walls are removed or absorbed, any upward movement is simply noise. Furthermore, the derivatives market is showing a funding rate that is heavily negative. While some might interpret negative funding as a potential for a short squeeze in a strong downtrend, it simply means that the majority of the market is willing to pay a premium to bet against the asset. Short squeezes typically happen when the market is over-leveraged in one direction, but the underlying spot demand is strong. In this case, spot demand is non-existent, so the shorts are likely to remain profitable and comfortable in their positions. We're also looking at the correlation between XRP and the legacy banking sector stocks. For years, proponents argued that this asset would move in tandem with the success of the financial sector. However, banking stocks have had a relatively stable quarter, while this digital asset has completely decoupled and crashed. This breaks the investment thesis that this coin is a proxy for institutional banking adoption. It is becoming clear that banks are building their own private ledgers, or utilizing stablecoins, rendering the public token less necessary for their operations. This realization is slowly trickling down from the institutional level to the retail level, causing the slow bleed we have witnessed over the last 6 months, culminating in this violent drop in February. So, what is the outlook for the remainder of the month and into March 2026? Based on the Fibonacci extension levels derived from the 2025 peak, we have not yet hit the technical bottom. There is a high probability that we will see a test of the psychological support levels that date back to pre-2021. If those levels fail to hold, we could enter a prolonged period of price discovery to the downside, where the asset searches for a fair market value that is significantly lower than where we are today. This is a dangerous time to be a hero. Trying to catch the bottom of a falling knife is the fastest way to destroy your portfolio. The smart play here is to accept the data for what it is and position yourself accordingly. You need to detach your emotions from your bag and look at the chart with cold, hard logic. The trend is your friend, and right now the trend for XRP is undeniably bearish. So, what is the playbook for navigating this turbulence? First and foremost, you must prioritize liquidity and quality over speculation. This is the time to consolidate your portfolio into Bitcoin, which remains the only asset with the institutional backing and regulatory clarity to weather this storm. Do not try to trade the volatility on these altcoins unless you are a professional day trader with a strict risk management strategy. The risk of getting wicked out or caught in a flash crash is simply too high. If you are currently holding a bag, you need to evaluate your thesis and ask yourself if you are holding because the fundamentals are strong, or if you are holding because you are hoping to break even. Hope is not a strategy. The market does not owe you a recovery. and it can remain irrational longer than you can remain solvent. Preserve your capital so that you can live to fight another day when the market conditions are more favorable. We will continue to monitor the on-chain flows and update you if we see any signs of a genuine reversal, but for now, the data points to further downside. Stay disciplined, stick to the facts, and do not let the noise distract you from the signal. Disclaimer: I am not a financial advisor, and nothing in this video constitutes financial advice. The content presented here is for educational and informational purposes only, based on my personal analysis of the market data. Cryptocurrency trading involves a high risk of loss, and you should always conduct your own due diligence and consult with a certified financial professional before making any investment decisions. The market is volatile, and past performance is not indicative of future results. Trade safe,